Chapter 3, Part 2, Accounting and Finance, Learning Outcomes. After having seen the aspects of financial statements with respect to balance sheet, after going through this presentation, students will be able to analyze market value balance sheet, common size balance sheet, income statement, and common size income statement. Later on, they'd also be able to deduce statement of cash flows and understand corporate and personal tax rates, and determine marginal and average tax rates based on a given taxable income. So book values are set on the value of acquisition at the time of acquisition for a particular asset. The generally acceptable accounting principles determine the way financial statements are created and recorded. So book value are the value of items when they were historically acquired at their cost. So some items like plant and equipment and other long-term assets are depreciated off, so their book value keeps on decreasing and then reaches a value of 0 when depreciation is enough to make up for the book value. The market value balance sheet, on the other hand, is not the same as book value, because all the assets are then and liabilities are then marked at the market cost, and we use a conservative principle. So if our liabilities are historically are going down in price, then we don't mark them to market because they're going down in price, but just understand that how much do we owe our lenders. So market value balance sheet is dynamic in nature, as the prices in the marketplace keep changing, and it's also cumbersome to maintain because you have to constantly keep on looking at the market values. And most volatile assets and liabilities that are fluctuating with the market value are bonds and other assets. Property, plant, and equipment, not so much, but it does change as well. Value of inventory is extremely volatile. Unpaid expenses, receivables, etc. could also change in value over time. And market value balance sheet is a much more accurate representation of firms' uses and sources of funds than the book value, and therefore it represents the reality. But it has too much changes for the accounting department in an organization to keep up with. So it's also a little cumbersome to maintain. Next, we move on to what's called a common size balance sheet. So in the common size balance sheet, all the balance sheet items now are maintained as a percentage of the total assets or the size of the balance sheet. So the benefit is now that we can compare a larger organization with a smaller organization in terms of their efficiency and the structure in general of what kind of sources of assets and liabilities they have. So let's now take a small example again of the coffee shop and use it in terms of creating a common size balance sheet. So we start a coffee shop, use a cash of $700. The balance sheet looks like cash is 700, owner's equity 700, total assets are 700, and TL and OE, total liabilities and owner's equity, is 700. But if we translate this into total size of the balance sheet, a percentage, so 700 divided by 700 is 100%. So everything here is 100%. So assets, total assets are 100%, total liabilities are 100% because of owner's equity. Now the next step we did was bought a machine for $500. So our cash decreased to 200, machines increased to 500. Owner's equity was still 700. To express this into common size, well, cash was now 29%, which is 200 divided by 700 times 100, and the remaining 71% is machines. On the other hand, owner's equity is still 100% of total assets, and total assets is 100% of total assets, and TL and OE, owner's equity, is 100% of total liabilities and owners of total assets. Next, we bought raw material with $100 in cash, no, in credit. So our cash remained 200, raw material increased to 100, machines remain at 500, but our accounts payable increased to 100, and owner's equity became 700. So the total size of the balance sheet now was 800, and everything is taken as a percentage of 800. So 200 divided by 800 is 25%, 100 divided by 800 is 12.5%, and 500 divided by 800 is the remaining 62.5%. On the liability side, this will be 12.5%, and 700 divided by 800 times 100 would be 87.5%, which is now 77.5%. Well, no, it should be 87.5%. So that there is a typo. It should be 87.5%. And that makes it 100%. So that is the advantage of seeing a common size balance sheet. Now let's take an example. So let's assume there are two airlines, MKZ and KMZ. So these are their actual numbers. MKZ airline is much larger. It has a balance sheet size of $64,000, out of which cash is $2,882. Accounts receivable is, these numbers are as here, mentioned here in the table. MKZ Airlines also has a larger size total liabilities and owner's equity. Look at common stock. The company seems to have bought back everything worth its common stock, and everything here in owner's equity is retained earnings. So $15,358 of retained earnings. On the other hand, KMZ is much smaller. It's about 16 times smaller approximately. And it has net plant and property of 3,000, cash and equivalents of 600, etc. It has liabilities of same 4127 because balance sheet has to balance. Its total owner's equity is 1,082. Total liabilities is 3,045. So what we notice here is the size of the balance sheet in both the years 2018 and 2019. Look at the cash, 2,882 for MKZ and 619 for KMZ. Then retained earnings for MKZ are much higher than the owner's equity of KMZ, which is much smaller. And so now we convert this into common size by dividing it by the size of the total assets. So here everything is now converted to 100%. And then we notice, wow, 100%, total assets is 100% of total assets for both the companies. Now cash for MKZ, the larger organization, is only 4.5%. And then cash for KMZ is 15%. So KMZ seems to be more liquid in terms of holding its cash assets. Moving on. How about owner's equity? Owner's equity for the larger MKZ is less than the owner's equity in terms of percentage of total assets for KMZ. So KMZ seems to be well capitalized. Moving on. Accounts payable. So short-term liabilities for MKZ are much higher than short-term liabilities for KMZ. So as a percentage of total assets, obviously. Lastly, the net plant and property for KMZ is much more stable as compared to MKZ. MKZ has 57.2% of net plant property, whereas KMZ, the smaller airline, has much larger proportion of net plant property and equipment. So all of this shows kind of much more stable structure for the smaller KMZ airlines as compared to MKZ, although it might or might not have a bearing in the long run. Now let's move on to the income statement. So it's a financial statement which shows revenues, cost of goods sold, which is cash and non-cash. So non-cash is depreciation, which we don't really pay, interest expenses on bonds, term loans, etc., and a net income of a firm. So essentially it is the revenue minus expenses and all other payments made, including tax to the government, interest to the lenders, and expense payments to various suppliers, etc. The profit that is left is available for shareholders to appropriate. It could be over a quarter, a semi-annual, or annual, or even multi-year income statements can be prepared using this method. The common size income statement is that income statement which is converted to a percentage by dividing it by the largest number on the income statement, which is usually total sales revenue. So divisor is revenue and expressed as a percentage. So let's go back to the coffee shop example. When we started the coffee shop, no activity was done in terms of affecting the income statement. Then we bought a new machine. Again, no sales was made, therefore no effect on the income statement. When we bought raw material, we're getting close, but we did not make a sale and therefore no effect on income statement. But keep in mind that we have carried out acquisition of raw materials, which will contribute towards the sale. So every dollar of raw material that we bought, when it is sold, will be considered as a cost. But right now we're not considering as a cost because we've not made sales. And so that every dollar applied to sales is called accrual. Now, when we make 10% of raw materials to be converted to final goods, that is coffees, we have still not made a sale, and therefore there's no effect on income statement. But we are very close now. So we have the final finished good ready. And moving on, so we made sales of $25. Although this is not a cash sale, as you can see, accounts receivable have increased to 25. So there's a credit sale. Even though we did not receive cash for our sales, it is still considered sales and income statement is ready to go. So sales revenue is $25. The 10% of $100 of raw material that we bought, assuming no modifications, no other extra expenses, is $10 cash cost of goods sold, not cash cost of goods sold. Whether it's cash or not does not matter. And assuming that we made no interest payments yet, we made no other tax payments, etc., the profit would be 25 minus 10, $15. Now, common size income statement is simple. It is 25 divided by 25, 100%. Cost of goods sold is 10 divided by 25, 40%. And remaining 60% is profit. So 100%, 40%, and 60% is how common size income statement is seen. Moving on to our MKZ and KMZ airlines. We have MKZ Airlines. Remember, it was a larger one, and it has a much larger sales revenue, $47,000. And it has earnings before interest and taxes. So this is earnings before interest and taxes. Revenue minus cost of goods sold minus selling, general and administrative expenses minus depreciation. Why are these three listed out separately? These three are listed out separately because cost of goods sold is directly attributable to the revenue that we make. However, selling, general and administrative expenses, particularly if we are selling multiple types of products. So CC's coffee shop, maybe it's selling cookies, maybe it's selling muffins, brownies, etc. The selling, general and administrative expenses will apply to all of those products. But cost of goods sold can be isolated with respect to the product we've created. So each raw material, etc., although that's also not a hard and fast rule, but broadly speaking can be isolated with respect to the final product. And depreciation is also considered separately because it's the nature of expense. That depreciation is a non-cash expense. We really did not spend $2,581 in cash. We only have accrued that depreciation expense because using whatever method we have, we consider that machine will be written off for whatever production we make as we go along, which gives us earnings before interest and taxes. And when we subtract the interest on loans that we paid, then we get earnings before taxes. So the I part goes away. And then when we make tax payment, the T part goes away. So it's basically earnings or net income or net profit or earnings after tax. All of these words can be used interchangeably. The most common verbiage used in the financial markets for revenue is top line, and for net income or EAT or net profit is the bottom line. So that's where the word comes from because it's at the bottom part of this income statement. And now we can see that 10% of revenues made by MKZ Airlines are actually profits. KMZ, on the other hand, is much smaller, as we remember, and therefore has much smaller profits. But it's not very far behind MKZ. It's about 8% of total revenues. So clearly, cost of goods sold is much higher for KMZ, 78% as compared to 49%. But KMZ makes up for it by not using too much of selling, general and administrative expenses. So that's how important ratios are that we learn from common size income statement. When it comes to the nominal numbers, we can have wildly different numbers, but we can put them on the same pedestal by using common size income statement. And ratio analysis, which we'll be studying in the next chapter, is going to underscore that importance once again. We can compare multiple firms across the industry using ratio analysis without worrying about their size, really. So the numbers here that are important are net income is structurally different from the two airlines. The percent of revenue is 100%. The percent of EBIT is 14 and 12% respectively, approximately. The percent of net profit is 10% and 8% respectively. So they're kind of similar in terms of their profitability. KMZ is slightly less profitable, perhaps because it does not have that kind of scope of its operations that MKZ Airlines has. To conclude, we saw how a common size balance sheet can be created by dividing and converting into percent of total assets. And common size income statement first of all is a difference of revenues, costs, interest payments, taxes, etc. to give us the earnings after tax, or the bottom line of the income statement. It comes from business activities and is measured over a period of time. Common size income statement, the divisor is total sales or total revenue. And it's important to compare different types of firms, even notwithstanding their size and scope. That is Chapter 3, Part 2. Thank you for listening.